this is my closet.
So at first she did her best to fit in, wearing a pair of glasses she didn't need and toning down her style.
So what's the kind of thing you used to wear to a conference?
Stuff like this, blousy things that make you look like you're 40.
But that got old after a while.
And what's the kind of thing you wear now?
Now it's like I just enjoy being kind of expressive and playful in what I wear.
Before we wrap up for the day, Danielle has one more LEQ tester to visit. Joseph is 97. And he's had the robot in his home for 8 months.
How are you?
I'm fine. How are you?
Good. How has Miss LEQ been?
She always tells me to take a drink of water at least 4 times a day.
So, we added a whole bunch of new facts to LEQ.
Did you know that a cup of chopped red bell pepper contains more vitamin C than an orange?
Okay. What did you think of that?
Certainly the print was, I could see that quite clearly.
What about this?
Well, I can see that. LEQ, play music.
No problem. It will begin shortly.
By 2050, almost 500 million people are going to be 80 or older. And if current trends continue, more and more are going to be like Joseph and Betty, living alone.
LEQ, stop.
Today, both of them are doing okay. But some of Danielle's other participants have been struggling.
Is it kind of hard to leave them at the end of the day?
It is. Some of our testers are pretty advanced in the stages of depression through loneliness and isolation. And at times, I know that LEQ is cheering them up in their day, but I know that it's only part of the way. No source of artificial intelligence robots will ever be able to replace humans and human companionship or human care.
The key to Danielle's work is to embrace that very limitation of machines.
Robots should help humans do what they love, help humans interact with more humans, help humans in general. Not pull humans away from humans, not take humans' jobs and leave humans without purpose.
Whether it's in our workplaces or in our homes, robots are soon going to be everywhere. And it's up to Danielle to make sure this robot-filled future leaves us just a little better off.
So don't be afraid. And if you are afraid, come and join us, because I promise it's a friendly place.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy, Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one. And that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit
and they say shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
Audience, I think, stay with you. You have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience, and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting. All right, throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point, because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi maybe, and leaves, right? Like it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. It's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
All right, a very good afternoon, everybody. It is Tuesday, March 7th, 2023. Carol Masser, Tim, as you know, is on leave. Back with me, Bloomberg News senior markets reporter Katie Greifeld. He came, he was seen, he put a kibosh on the risk trade. We're talking about Jay Powell. Kibosh?
Kibosh, I think, is a good word. I mean, just the size and scopes across markets right now. You were talking about the 2-year Treasury yield with Joe Matthew. You look at the 2-year, 10-year yield curve.
More than one full
More
point.
than 100 basis points of inversion. We haven't seen that, I don't know, since the 80s, something like that.
Are you running for the hills yet?
It seems scary. I don't know. We should talk to some smart people about that.
Well, funny that you say that, funnily enough. Ken Griffin, as you heard Joe talk about, of course, founder, head of Citadel, excuse me. We're going to have a conversation. He's part of a panel. We're going to take you there live in just a few minutes. We're also going to talk about, again, China. More stuff coming out overnight. They've got a warning for the United States. We'll talk a little bit about that.
Containment, I heard.
Containment. I'm a little worried. We're also going to talk about lithium. It's all the investment rage. We're also going to talk about what's going on with metaverse, man. The efficiency. I guess it means more job cuts.
It seems like that's the writing on the wall. I don't know which metaphor I want to use, but just the latest in a series that we've seen from these tech giants.
We also have the CEO of the Digital Investment Advisors. Some call them robo-advisors. We're talking about Betterment. Sarah Levy, she's going to be with us talking financial wellness, but I'm also curious about what she's seeing about the financial health of what the users on her platform, how you would describe the state of that, if you will. And then we've got a great person who spent 10 years at Google. She's COO or was COO at Stripe. She's got a book out called Scaling People. Claire Hughes Johnson will be with us. I feel like in a tight labor market, we'll get another read on that on Friday, talking about the importance of people in your organization is certainly front and center.
Oh,
how are you feeling?
I'm ready to go, I gotta say.
All right, good thing. I'm looking at a 2-year at 5.01. I'm looking at a sell-off in the equity market. Right now, it's time to head over to our TV team. That's because Countdown to the Close starts right now.
Countdown to the Close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left to go here in the trading day. Romaine Bostic, Scarlett Fu, joined right now by our colleagues Carol Masser, Katie Greifeld in as well. Welcome to our audiences across Bloomberg Television, Radio, Bloomberg Originals, and those folks streaming on YouTube. A market right now, equity market around the lows of the day. And Carol, we were just talking about it on Bloomberg Television, a 2-year yield now above 5%.
Yeah, absolutely, right? We haven't seen this since 2007. Kate and I were just talking about the spread between the 2 and 10. You're talking about 100 basis points. We haven't seen that in a long, long time as well. So Jay Powell, he came, he spoke, and the markets are certainly feeling it. Having said that, most of the equity universe, we're seeing a lot of selling. What is one group standing out are the airlines. I heard you, Romaine, talking about it earlier on Bloomberg Television. Let's bring it up for everybody. If you look at the S&P 500 Super Composite Airlines Index, it is up more than 1%. A couple things going on. You had multiple carriers upgraded by analysts, among them UAL and Delta. They are both flying, no pun intended, or maybe pun intended. UAL's up 3.4%. You got Delta up about 1.5%. Different organizations doing the upgrades. And then Cowen analyst Helene Becker came out. Yeah. She's always an important voice. She said the industry's demand and pricing are still strong. She says the DOJ's decision to block the merger is a positive for the rest of the industry as it keeps those two distracted. We're talking about JetBlue, who is looking to acquire Spirit. If you look at Spirit, that name, Katie's up almost 5%.
Yeah, can I just interject too on JetBlue too? Because I saw just crossing the terminal a few minutes ago here that we did have an interview with Robin Hayes about that suit, basically saying that they do plan to fight it and that they're confident that they can win in that trial.
And we'll continue to follow that story. I want to go back to the bond market, though, because that's where all the action is today, firmly in the front end of the yield curve. You have 2 years Treasury yields up 12 basis points. You add that together with what's going on with the 10-year part of the curve. You have a 2s-10s curve, like Carol said, below 100 basis points of inversion, 103, 104 right now. Finally in the triple digits. Some people had been calling for this around the start of the year. It seemed crazy, but just the speed of this move has been really breathtaking.
Yeah, you take a look at some of the individual movers. This has really taken a chunk here out of any enthusiasm. You're looking at the broader market here with the S&P down about 1 point. 6% here on the day. The Dow, pretty much the underperformer here on the day, down about 1.7%, Scarlett.
And it's all red across the screen when you look at the different industry groups, whether you slice it into 11 or 24. And at the very bottom of the pile are banks, financials. And that goes back to the story that Katie was just mentioning, rising yields. KeyCorp yesterday, of course, said that it sees its net interest income rising only between 1 to 4%, less than its prior guidance of 6 to 9%, getting squeezed as they have to raise rates for depositors.
Yeah, let's take a quick look at some of the individual movers. Apple, which of course had been one of the bright spots here in recent memory, down 1% or so on the day. Snap, we were talking about this yesterday, getting a boost here from some of the concerns about a potential ban on TikTok. And we should point out that just crossing the wire a little while ago that Senator Mark Warner in the United States Senate has finally unveiled that bill that would effectively ban TikTok. Snap shares up 1.5% on the day after rallying more than 10% yesterday. And you were just talking about the bank, Scarlett. Wells Fargo, emblematic of that, down about 5%. Flip it up real quick and put the inversion back on the board here, Katie. I think you had this up a little bit earlier. My chart's a little prettier than yours, but it basically tells the same story. And I think this is interesting, guys, because it gets to the broader question now here about what the market positioning can be going forward. Are they going to start to price in a recession, or is there a case to be made for a soft-ish landing?
Yeah, it's interesting, right? And I guess time will tell on that. What we do know for certain, thanks to Jay Powell of the Fed up there on Capitol Hill, is that the Fed ready to do more and be more aggressive about it. Here's what he had to say.
The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
All right, so ready to do more and to do it more quickly if needed. Of course, that's Jay Powell up on Capitol Hill earlier today, Katie.
And I think both of those added together is why you're seeing what you're seeing. But the fact that the door is open potentially to 50 basis points to reaccelerate from 25 to 50, we haven't seen that in a long, long time, certainly not in modern tightening cycles.
He talks about totality of the market, of the data, and of course that's what we're going to fixate on. But you know that come the jobs report on Friday and the CPI report on Tuesday, there's going to be a lot of positioning and scrambling before and afterwards.
I am curious, though, but we talk about just how mixed that data is. It's easy to say, oh, we're data dependent, and the data shows a strong economy. There's a lot of data that shows a weak economy, too.
Yeah, I mean,
Am I crazy, Carol?
No, you're not crazy. But what was it? And Mike McKee kept saying that Jay Powell said about the totality of the data, right? So he's looking at everything. And so that kind of gives him a little bit of an out. But we got an important guest who's going to probably address some of this.
Yeah, Ken Griffin taking the stage right now, down at an event in Palm Beach, Florida. Our Miami Bureau Chief, Felipe Marquez, sitting down right now for an exclusive interview. Let's dive into that right now. Ken Griffin, folks.
I have a few paintings, but I can't paint. Or music, and I'd have to pay you to be here if I were to sing. Literature, which is just not going to be our forte today. So it's drama is the fourth category.
Yeah. I'm trying to pivot your talents here.
So we're going to have to play with that as our theme today. We're going to have a good conversation with a bit of drama to make sure that we're in keeping with the history of the 4-Art Society. Now, if we think about the economy, that's not going to get a lot of drama going, except for last year, with inflation at near record highs in our lifetime. It was a pretty traumatic experience for American households. We saw negative real wage growth for workers in America, and for retirees who are usually on fixed pensions and who are depending upon their savings to maintain their standard of living. Last year was a particularly horrific year. And that increase in inflation, driven by the sheer magnitude of the stimulus spending on the back of the pandemic, really caught our policymakers offsides, and in particular forced the Fed from going from a position of being incredibly accommodative to, in recent months, rapidly raising interest rates at one of the fastest paces ever to try to put the inflation genie back in the bottle. Now, when you manage money, you make money by having a difference in opinion as compared to the broader market. And for us, the difference in opinion that we had was that inflation was going to be very hot, and it was, and that was a source of revenues for us last year. This year, I'm actually really pleased that we're not far away from consensus on inflation. The market overall thinks inflation is going to head back towards the upper twos in the foreseeable future. And we are not materially different than market consensus at this point in time. So I truly hope that the market's right on this call. January gives us some pause for concern. Labor market, red hot in January. We don't know how much of that is the weather effect. January was unseasonably warm. We're gonna know a lot more in a few days when we see the February payroll numbers, which we expect will be much closer to 200,000 in growth versus 500,000 plus in January. That'll give the Fed a bit of comfort that they're getting the job done of cooling the economy, bringing down inflation, and putting that pretty evil inflation genie back in the bottle.
But then what's your take on what Jerome Powell said today, that the Fed was prepared to increase the pace of rate hikes and that the terminal rate is likely going to be higher than previously anticipated? A lot of people are reading that as a sign that they're going to go faster.
So he created space today to move by 50 basis points on the next hike. You know, they'd come into this year pretty clearly telegraphing that 25 basis points was going to be the per meeting rate hike for the early part of the year, and then in some sense, taking the foot off the brake and seeing where the economy lands. And in fairness to the Fed, the interest rate tool as a means of controlling inflation it's like having surgery with a dull knife. It is a really difficult tool to get the job done with, because you hit the housing sector, you hit the manufacturing sector, you hit parts of the economy that have a very high sensitivity to interest rates, and you tend to leave the rest of the economy relatively untouched. So the Fed doesn't have as much impact with their tool as you might hope, and although they've raised rates considerably, it's not clear how long the lag effects are for the impact. And once the impact starts to play out, how damaging that impact is. So they're in uncharted territory. It's a difficult place to be. If I could tell one thing to the chairman, I would tell him to say less. I would just be writing a message. We're going to put the inflation genie back in the bottle. We're going to do what it takes to make that happen, and we're going to raise rates consistently until we see very clear evidence that we've put this behind us. Because every time they take the foot off the brake, or the market perceives they're taking the foot off the brake, and the job's not done, they make their work even harder. And at the same time, remember, they're impacting in a very, very harsh way a very small part of the economy. And that's really tough for those businesses that live in that part of the economy.
So you're talking about the damage. Do you think we could see a recession this year?
So we have the setup for a recession unfolding. What we're seeing is that the American savers did what you'd expect. The American consumers did what you'd expect over the pandemic. They were handed enormous amounts of money by the government. Most were able to keep their jobs because of work from home and otherwise. And let's be clear, you couldn't go out for dinner with your friends, you weren't traveling, so you saved money. And the American consumer saved trillions of dollars. Now, the flip side of this is the U.S. government spent about $5 trillion over the pandemic to allow us to stay at home and sit on the sofa. Put $5 trillion in context, we spent about that much money in real terms in World War II to win World War II. We spent as much money in the war against the virus as we did to save the free world in the 1940s. And that money that went to American consumers has been coming back into the economy post the vaccinations, post the reopening of the economy, and it's been spent at a torrid rate. Best guess, there's about $1 trillion change left of excess savings that's being spent at roughly $100 billion, $120 billion a month, which means by the end of this year, in some sense, the punch is out of the bowl. And that makes next year, late this year, a very interesting transition point as this post-pandemic orgy of spending comes to an end. And then we'll see the true strength in the economy, and that's going to be a really interesting moment in time.
So you promised drama, and as of now, we had the orgy of spending and the dollhouse knife surgery, which I thought was a lot of drama.
We like the doll knife one, yes.
Yeah.
And I do think that everyone has these very high expectations that the Fed can just work magic on inflation, and they don't have it that easy. And that's why I really believe that the consistency of messaging is so important, because part of how the Fed gets the job done is the perception of the American public that they can get the job done, right? Inflation has a significant component around expectations. If you think prices are going higher, you're going to be much more demanding in your wage negotiations as a union, for example, or as an employee. You're going to really be focused on how to get your wages up as fast as you can because you see the bills coming your way. When the Fed breaks expectations of inflation, it does wonders in terms of helping make the economy work better.
Do you think they're doing a good job in framing the message?
No, I think the variance in the message over the last couple of weeks has been incredibly counterproductive.
Okay. And what do you think is the terminal rate ultimately? I mean, how far are we going to get and how long are we going to stay there?
You know, the markets are pricing in that we'll see Fed funds somewhere in the mid-5s. That's probably about right. And of note, the market predicts that by the end of next year, we'll have cut rates by 200 basis points. So the broader financial markets thinks that we're heading towards a very sharp peak in rates in the months ahead, followed by a period of relative calm in rates, and then a pretty fast cut in rates throughout 2024.
Is that your perception as well or no?
I think that's probably a pretty fair assumption as to how the market's going to play out. We are going to hit this moment in time where clearly inflation is decelerating and the punch bowl being empty. We're going to see the economy start to slow as demand fades away.
So we're running a big story on Bloomberg today about how markets are basically shrugging off the risk of a debt ceiling standoff. At which point do you think that becomes a relevant theme for the markets? Is that risk underappreciated?
So regretfully, there is very little common ground between the two parties that are in power today. In fact, I'm not sure there's any common ground between the two parties that are in power today. And as such, unfortunately, it will probably not be until we have the volatility in the market that goes with an impending default that we will actually see cooler heads prevail, a compromise reached to kick the can again to the typical budget process where we'll see, I think, the real contours of what the magnitude of government spending cuts will be and or the nature of tax increases will be. So I think the debt ceiling will be a non-event until it is an event. That event will shake the confidence of the House and Senate. They'll find a common ground to kick the can again. They're very good at that. It's a national sport. And then we will address this in a haphazard, mediocre way later this year in our routine budget process.
But there will be a compromise.
I mean, God willing. And I do think it'll be the market volatility that will drive that compromise to kick the can. And the reason we have to do this is America owes about $30 trillion today. And if we defaulted on our debt for even a minute, the increase in interest rates that we would pay for decades to come would cost our economy dearly. I mean, if you think about it, if our current $30 trillion of debt had to all be refinanced at today's prevailing interest rates, we would spend about 6 2/3% of total GDP just servicing our debt. That means you'd start work in January, and by roughly the second half of January, having had no money to take home, you would have worked long enough to pay the interest bills for the year on the U.S. debt.
You mentioned that one of the ways Washington was trying to carve out a way of this was tax hikes. In fact, President Joe Biden said yesterday that he was considering a tax hike in incomes above $100,000, right? So do you think that's the right policy? That's the right way to go?
So the Democrats are very enamored with the political talking points of raising taxes on the rich. And that works for a very brief period of time, but there's just not enough money there to pay the actual bills. And so unless we are willing to bring spending under control, we're looking at tax increases for all Americans. You know, in Illinois, for example, which has a chronic deficit spending problem, unfunded pension plans in the hundreds of billions of dollars, they haven't been able to raise income taxes yet, but they've raised almost every other tax you could ever imagine, from gas to property. And those taxes actually they're not paid by the wealthy as much as they are by the people who are in the lower class and middle class. They're incredibly regressive. So if you look at a state like Illinois, which prides itself on being so progressive, and then you look at where the tax burden actually falls as they continue to try to put their balance in budget, it falls on the very people that government claims to be interested in protecting. And so what I'm worried about is that the talking points are cheap, the political victory that comes with it is cheap, but the hard work comes from having to have the real tough decisions about where to cut spending. And of equal importance, how do you take the tax base and broaden it and not just find taxes that disproportionately affect people in America that are living paycheck to paycheck trying to make their bills happen?
You mentioned at the beginning of our conversation that your vision for inflation doesn't differ that much from the market. What exactly how are you positioning with the fund right now? Like, where are the biggest opportunities for a hedge fund like Citadel right now?
So we are constantly positioning our capital against where we have a differentiated view as compared to the market. So for example, if we think a company is going to announce strong earnings for a quarter that others don't anticipate, and perhaps guide for stronger future results, we'll be long that stock.
So where do you have a differentiated view now?
Right now, I would say it's fair to say that we're somewhat licking our wounds from the incredibly strong economic data in January.
Really?
So we did not anticipate that we would see such strong economic data in January, and that's forced us to reevaluate our interest rate and inflation positions here in the United States, or for that matter, around the world. And part of what we do, I think, very well as a firm is we accept reality, which is, wow, we didn't see this payroll number coming. We didn't see the inflationary print that went with this. We've got to go back to the drawing board and rethink our framework and redecide how to deploy our capital. And we'll do that for a couple weeks, and then we're back at it. But very successful investors are very quick to acknowledge when they've got it wrong. And they don't let, I think of it as like thesis creep come into play. When you're wrong, you're out, you reevaluate, you decide what to do next. And that can sometimes mean doing the exact opposite of what you were doing just 8 weeks ago. And in particular, with rate markets around the world as volatile as they are, we are constantly changing our position from long or short rates in various countries around the world, like every couple weeks.
You've mentioned Illinois' policies, and I can't help but think of the contrast with Florida, which is where we are right now, right? And then I wanted to shift a little bit of the gears here and talk a little bit about Florida. So we're in Palm Beach, and I'm sure our audience is going to remember that at the height of the pandemic, Ken turned the Four Seasons ballroom, into this gigantic trading floor, the heart of Citadel Empire, just 6 miles down the road. And then apparently he liked Florida so much that he decided to bring the entire company here. Ken, how's your life in Florida?
Well, actually, let's go back to that story for a moment.
Okay, did I tell it wrong?
No, it's close enough. It's close enough. We realized that we needed the ability to maintain markets in the U.S. equity market at the start of the pandemic. We're the largest trader of equities in the United States. We account for roughly 1 in 4 shares that change hands every day. So we have a job that transcends just being here for Citadel. We view ourselves as we want to be here for the tens of millions of retail investors that count on us to provide liquidity, and the thousands of companies that look to us as being their principal market maker in their stock. And at the Four Seasons in Palm Beach, in about 5 days, we built a trading floor that could have handled the entire equity volume of the United States of America.
And right now they are using it for parties.
So I took my son to the Four Seasons when we were doing this. I wanted him to see what 200 people working at midnight looked like, because this is how you make things happen. And when we finished that trading floor build out, we put 100 and some of our colleagues and their families there, shut the doors, no one allowed to enter, no one allowed to leave. So to the MBA, this is how you build a bubble, and this is how you do it fast. And that served us incredibly well. We were able to handle our trading in the U.S. equity market flawlessly throughout the pandemic. And I would say that I have a debt of gratitude to the leadership of Palm Beach, the city, the county, and the state for their willingness to help us make that happen in 5 days. I mean, in New York, we'd still be filing paperwork to do this. And it's a real testament to the get things done mindset that goes with leadership in Florida. It is so palpable when you meet with the government leaders and civic leaders in the state that Florida is open for business. They want firms to be successful here. They want firms to be successful here, and they want people to have a high quality of life here. Now, it's not a secret. I have some property here in Palm Beach, and I have this rolling dream that one day I'll build a house here and I can retire here one day. It wasn't me who drove the decision to come to Florida. It was the 100 and some people that lived in that bubble who said, why would we trade the anarchy in Chicago for the tranquility in Florida?
So let me ask you the next question then. One thing I'm fascinated with is that you're relocating a gigantic company with more than 4,000 employees around the world to Florida. Obviously, not all of them are going to live here, but how many employees do you plan on having here in Miami? Or do you plan on having in Miami? How many you plan on having in Florida? Like, how's the planning of moving people to Florida going?
So it's going, well, here's the biggest challenge. The biggest challenge right here, right now is getting office space. Because we're not the only people who are saying, you want to be in Florida. And the migration of talent to this state is just mind-blowing. So I would say that by sometime late this year, we'll have 250 people in Miami. Yeah. I would think 3 to 5 years out, we'll have between 700 and 1,000 people in South Florida. Mm-hmm. And I'm really excited about that. Many of my most senior leaders have either moved or are moving to here from our offices outside of New York City. And that's important to stress. New York is one part of the United States where people are very optimistic about the future still. And the mayor of New York understands clearly he has to address the issues of crime. It's a big focus of his, and I applaud him for speaking out on this issue after Lori Lightfoot was defeated as mayor in Chicago. And we have a really big commitment to New York City because a number of my senior team members, that's been home for their careers. That's where they want to be. So in the United States, our two premier cities will be Miami and New York. Mm-hmm. And then, of course, in Europe, London's an incredibly important city for us.
Are you still going to keep an outpost in Chicago or no?
I think you picked the right choice of words.
Outpost.
There'll be an outpost. No, I have a number of colleagues in Chicago from whom Chicago is home. And for a litany of reasons, they're not going to leave Chicago. And I'm frankly grateful for them being on the team here at Citadel. We're going to have to move offices in Chicago to a safer location. I mean, where our office is literally not where we want to be because of just pure safety concerns. I mean, when you've got hooligans lining the street, throwing things at ongoing cars outside the front door of your office, you know you're in the wrong part of town. The challenge is there's not many right parts of town left in Chicago. And it's a serious problem. If I put a video up here, you'd almost want to cry. You'd go, that can't be America.
Since you brought up Chicago, I have to ask you about the mayor run. Obviously, you just mentioned that Lori got defeated, but do you have a candidate for the runoff, or you're not following it at all?
So I'm out of Chicago politics. like a salmon swimming upstream to die.
Oh, you brought it up.
I've had enough of Illinois. I will tell you, I really admire my colleagues who have supported Paul Vallis publicly with their voice and with their money. I hope that Paul Vallis becomes the mayor of Chicago. I think he's the best choice for the city. But Illinois has got a tough road ahead of it. It really does. Until Springfield chooses to change course, and prioritize jobs, education, and public safety, I think it's a lost cause.
Let me just get us back a little bit here to Miami and to Palm Beach, actually. So you mentioned that you have property in Palm Beach, and you also have commercial property here in Palm Beach. Can you tell us a little bit more about your plans for that?
I'll keep that short and simple. We have commercial property on Worth Avenue, and we will be redeveloping it to have a fantastic storefront experience, restaurant experience, and office space on the second and third floors.
Mm-hmm. Do you already have the tenants or no? That's tenants.
The challenge is, it's not that do we have tenants, it's picking who we want as a tenant. I mean, you cannot believe the number of incoming phone calls of people looking for space here in Palm Beach. In a building that's not that well known that we own publicly. But it seems that people that are in retail or in restaurants are able, they want space here.
How long that redevelopment is going to take?
I'll be updating that actually in the next 2 or 3 weeks. So that's on our list of development projects right now. And that one's important to me. It's right here in Palm Beach.
Yeah. Well, it's important to all of these people, actually.
Yes, the Neiman Marcus store needs to be returned back to its place of grandeur here.
And since we're talking about real estate, you actually have plans to build what's going to be a standout tower in Miami. You have plans to build a standout tower in New York. How is life of Ken Griffin real estate mogul now? How is being a real estate tycoon?
Well, I'm not. I have land. Between land and buildings, a lot of work. But let me tell you why we're going to build these buildings. We have been committed to return to the office from literally the early days of the pandemic. So we spent an incomprehensible amount of money to bring our people back to our offices right out of the gate at the start of the pandemic, for whether it was COVID testing or robots with UV lights to clean the bathrooms, social distancing requirements. You could just imagine, I felt like I was running a healthcare institution for a period of time. But why would we do that? I think there's just incredible value in people collaborating together, working together, innovating together. And come summer of 2021, we brought everybody back to work 5 days a week. I ask a lot of my team in doing so. We're in a world where that's not common yet. What we have found is our team has embraced this, but we want to make sure that we have facilities in our 2 primary cities that represent the commitment that we want to make to our team members in terms of their sense of health, safety, quality of life, working environment, that parallels the incredible commitment that they make to each other and to the firm. And therefore, we're going to be building a new skyscraper in Miami and a new skyscraper in New York, which will fulfill that goal of ours.
How easy it is to get people in Miami who actually live by the beach back to the office 5 days a week?
Well, since they all came from Chicago, they didn't know that life. And there's no signs of a different work ethic in Miami than there was in Chicago. I mean, my colleagues love what they do. They enjoy working with each other. People talk about, well, if you go to Florida, will people be as committed to their work? Look, if you go home and it's blue skies and it's sunny and your kids come home from school and you know what? They're happy. And it's amazing how a school devoid of woke ideology leads itself to happy children. I think people are much, much happier in their lives and in their careers when their personal life is in a good place.
So here, the audience, I'm sure, has one big question that they want me to ask. A lot of people here have their own charities, and I know that you've been ramping up your charity givings here in Florida. What are your priorities here?
Education, then education, and a bit more education. So that hands down is the biggest priority. Both supporting the schools in Miami that support the community, that's really important to us. We can see the impact of so many people having moved to Miami on the educational infrastructure. And then how do we support the institutions of higher education? Because for us, that's such an important source of talent. You know, in Chicago or in New York, your Columbias, your NYUs, your University of Chicago's, these are really important feeder schools of talent. How do we make sure that Miami has strong programs in areas in STEM that feed us our talent base? So that's really number one, is education. And that's not just at the upper echelons. You know, one of the things that we supported during the pandemic here in Miami was broadband access for children of lower income households. How do we help to cross the digital divide such that every student in Miami has a chance to realize their full potential? So education, hands down, number one. Number two is public safety. And you know, this is why Miami is so great. In Chicago, we had real success with creating facilities that integrated predictive analytics so that the police force could better deploy their resources to improve public safety. And when we did this in Chicago under Mayor Emanuel, who I think the world of, it brought crime down, murders down by remarkable double-digit percentages in many of the communities that this was deployed. Now, all that value was lost in the J.B. Pritzker, Kim Fox, Lori Lightfoot days, but Miami embraced that. And we're gonna support that build out across metropolitan Miami as Miami continues just to bring its crime rate down. Like, I love the commitment that they have to the streets being safe, where you can walk outdoors between a restaurant and your house and just not worry. It's hard to imagine in Chicago. You know, I have friends that would take Ubers to go 4 blocks. You just didn't want to be on the streets. And if it sounds melodramatic, like, I had 4 colleagues robbed at gunpoint at Citadel. I had a colleague stabbed a few hundred yards from the office. I had 2 colleagues with bullets flying through their car. I had roughly 25 bullet holes in the front, or the first story of the building where I live. The store across the street from me, they drove a van through the window to help facilitate stealing all the goods from the store. And my favorite is they tried to carjack my security driver from the front door of my house. So if it sounds like a third world country, I actually think it's unfair to most third world countries, where the respect that people have for their neighborhoods and one another seems to transcend what is now tolerated in Chicago.
Then what would you say is you really mentioned kind of like what you see the benefits of being Florida. What would you say are the downsides?
So the city is going to well, Miami in particular is going to have to deal with affordable housing. Now, because they have good zoning laws here that will facilitate builders building, the housing issue will address itself in due course, but due course can be years, and there's people struggling with the increase in price in housing. You know, again, you've got all these people moving here, that puts a demand in place for real estate, and the locals just, they're now competing with people that have moved from New York, they've moved from San Francisco, they've moved from across the country. That has really led to a dramatic level of housing inflation. And the faster that we can build housing in Miami, the better. So that's a challenge. And frankly, credit to the government for being very on top of this and for working with the development community to help address that problem. That's shovels in the ground, that's getting buildings built, that's really important. You know, we talked about education already, the sort of surge of students coming to Miami. That's a big lift. And if you talk to the private schools, they're building new buildings. They're going to build new campuses. They're going to open new facilities. So we're seeing the supply side respond to this. And of course, the public school system will have to build new schools, will have to augment their current facilities. So we're seeing that be addressed. Congestion's a problem. There's a lot of cars on the road. When it's all said and done, though, you'd much take this set of problems as a city than the inverse. And I've lived through the inverse. You know, we talked about people moving to Miami. Illinois had a massive exodus of people over the last decade. Something like, I think it's 200,000 people left in the 2 years of the pandemic. All of a sudden, your schools are 60% full. Your streets in the city are empty. Your restaurants are closing. You'd much rather take the challenges of growth than the challenges of a declining state.
So you've already brought up politics in this conversation, so I have to ask you about that as well. I mean, we were talking a little bit about your philanthropic giving, but you're also one of the biggest political donors in the country right now. And we interviewed J.B. Pritzker at Bloomberg recently, And he said, and I'm quoting here, he was willing to spend whatever it takes to keep Republicans, namely Ron DeSantis, out of the White House. Are you willing to spend whatever it takes to get him elected?
Well, I would spend whatever it takes to make sure that J.B. Pritzker's never in the White House. I mean, you know, what's funny is in Illinois, you know, the J.B. was in a race for the governor against a to-be-determined Republican primary candidate. And I supported a man, Richard Irvin from Aurora, who was a fantastic mayor, really, really solid person. And I knew early on in the primary that we were actually moving to Florida. My kids had applied to go to school down here. We bought a $300 million parcel of land in Miami to build a new office building. And I found myself writing checks for about $50 million to support Richard Irvin, knowing I was going to leave. Now, JB, to his credit, won the primary on the Republican side by supporting the mega Trump candidate, who he constantly would deplore in the actual runoff, but he spent $35 million meddling in the Republican primary to try to position himself against the weaker of two candidates. Why would I spend $50 million in a Republican primary in a state that I had no intention to live in? I thought the best gift I could leave Illinois was good leadership. And it breaks my heart that he was reelected, because the state of Illinois deserves good leadership. My family traces its history back there for 100 plus years. Illinois will always have a special place in my heart, but I watch the policies of J.B. Pritzker destroy one of the great states in this nation. It breaks my heart. So I will absolutely spend whatever it takes to make sure he's never president. Now, on the Republican side, you know, we're going to have a really interesting primary ahead of us. I'm not going to talk about Ron DeSantis, because the state of Florida speaks for itself.
Really? People here are going to be very sad.
No, actually, they won't be, because he won the state in the re-election for governor by an absolute landslide. And I think that speaks to what people want in their leadership. They want a government that works for them. They want a government that is thoughtful about minding their checkbook as taxpayers. They want their children educated. They want their streets to be safe. And they want their communities to prosper. I think that's a simple message. And I don't think I need to talk about Ron DeSantis. I just need to look across the state and realize that message is being delivered here in Florida. Now, I'd like to see that message across America again. It is absolutely heartbreaking to see where the progressive liberal agenda is being unleashed and the damage it's doing to our cities, and more fundamentally to our children. What we do to ourselves as adults, that's up to us. But in Illinois, there's 53 schools without a single child at grade level. That's where J.B. Pritzker's policies lead you to. And when we take away a future from a child, it's almost like the most hideous form of silent homicide ever. We are destroying their dreams before they have a chance to even exist. That's J.B. Pritzker's world. So the American voters, I think, will see what opportunity looks like when they look at the state of Florida in 2 years. They'll make a decision, and I think that the results in the state speak for themselves.
Do you think Ron should run?
I would love to see him run.
And then I know you said you wouldn't talk about DeSantis, but let me ask you one question about him then, and we'll move on to another topic. What policies that he has that you actually disagree with? Because you said that you listed all of his successes: education, crime-fighting policies. Which ones you are not 100% in line with?
Well, I mean, here's the big picture. There's no politician where any of us are going to be in line with all their policies. Like, that doesn't exist. All right? Like, every politician's strengths, what you like, weaknesses, what you don't like. All right? This is ubiquitous. I mean, the New York Times wrote this really nasty article about Rahm Emanuel because I was one of Rahm's big supporters. I'm like, why don't you applaud the fact that the two of us who are on two sides of the aisle can find common ground on 90% of the issues that matter to our city? Why don't you applaud that? Why don't you think about how good it is that we're aligned against education, we're aligned against having safe streets, we're aligned against having a prosperous business community? Why do we need to find fault when we find the ability to find common ground? Now let's talk about Ron for a second. He as governor of the state of Florida. I've said before, I don't agree with how we handle the Disney situation in the end. It's my personal opinion. I think it's intimidating when the government takes steps that may look or feel like retribution. The CEO of Disney picked a fight with Governor DeSantis. Governor DeSantis is allowed to pick a fight back. But that should be a choice of words, and I think that removing the special governance status of Disney in their home county, that feels like overreach. That feels like retribution. And even if it wasn't, the timing's terrible. And the reason that that's so problematic is if you're a small business owner, you say to yourself, well, wait, if the state can hurt Disney at a whim, they can wipe me out in a moment. And that discourages entrepreneurship, and that discourages the wheels of commerce. So that's one that worries me. I'm worried about the messaging around the vaccinations that the governor's currently engaged in. It's a really tricky issue, and this one strikes close to home. Operation Warp Speed originated at Citadel. It was a conversation I had with the White House at the start of the pandemic about the value of us pre-purchasing vaccines before we knew if they worked. Time to market. If we have to wait for a vaccine to be approved, then we ramp up manufacturing, we're going to lose valuable months. And that means we're going to lose hundreds of thousands or millions of lives. Why do I worry about the governor's messaging here? Right now, we're very fortunate. The coronavirus has mutated from Delta to Omicron. Omicron is, thank you God, it is for most people like a very bad cold. Delta goes right for the lungs. By the time your immune system can respond, you may be dead. Omicron goes for the sinuses, the upper respiratory tract, the throat. It's much less deadly. But if we create a mindset that vaccines are just intrinsically dangerous, and there are nuanced points where he's right. For teenage boys, it's not clear to me you'd want to vaccinate them. It's a really interesting debate. But if you make people fearful of vaccines, and we see a turn to a more dangerous strain again, and there's no assurance that it's a one-way street that we go Delta to Omicron, and the next one's even less problematic. It could be more problematic, but if we've made people worried about taking vaccines, there could be an enormous loss of life. So that, for example, is one where I don't agree with the governor's, I don't agree with his choice of words or how he's positioning the issue. And again, he has a lot of good points behind the dialogue, but when you're in public office, you have a very loud voice like he does, and I love much of what he has to say. Those nuances can get lost.
So I'm conscious of the time here, and I have to open the floor up for questions. But I do have one question before I do that. So I've actually brought someone here to ask you a question, and that someone is ChatGPT. And by the looks of it, ChatGPT is asking you for a job. Because I asked him, what should I ask Ken Griffin? And he said, well, you should ask Ken Griffin about the role artificial intelligence is playing in finance in coming years. So Ken, have you ever actually used ChatGPT? And how do you use that on Citadel? Are you offering him a job? Or it, right?
Well, so it's a great question. Raise your hand if you've used ChatGPT.
Oh, that few.
All right. I'm just going to say this. You've got to go home and try it. All right? Because you can literally pose it a question and it will answer your question. You can say something like, write a story about a murder mystery at the Four Arts Society in Palm Beach. And it'll write a story.
With Ken Griffin as the lead character?
I don't want to be the protagonist in that story necessarily. But you can generate, it'll generate that story on the fly.
Okay.
You can also give it computer programming code in one language and say, please convert this to a different programming language. and it will do that. You could say on the next generation of it, draft me a lease contract to lease my house. It'll write the lease. This branch of AI will be game-changing for the economy because it will take an enormous amount of work that's done today by people and do it in a distinctly different, highly automated, highly efficient way. And that will have real bearing on our economy. That's going to be a game changer for the economy. And like most changes in technology, with clear winners and losers. But this is going to be the future, and it's worth going home, signing into ChatGPT, open an account, and experiment for 20, 30, 40 minutes, and impress your grandchildren. Like, they'll think you're so cool for doing this. It is the fastest growing consumer application in the history of the internet.
Have you started using it as Citadel?
We are right now trying to negotiate an enterprise-wide license.
Really?
Yes.
For what, specifically?
Everything.
What are the ideas you're throwing around?
So everything from helping our developers write better code, to translating software between languages, to analyze various types of information that we analyze in the ordinary course of our business. This branch of technology has real impact on our business. And I'm actually really excited to see how this changes the world.
So I have to open the floor up for questions. And while I do that, we'll do like a lightning round just so we can actually cut the live feed because questions won't
All right,
be live
everybody.
streamed.
Carol Massar along with Katie Greifeld live in our Bloomberg Interactive Brokers studio. You've been listening to Ken Griffin, Citadel founder and CEO, in a discussion on the future of finance there in Palm Beach, Florida, there with our Bloomberg News Miami Bureau Chief, Felipe Marquez. If you would like to hear more of it or continue watching and listening to it, just head to Live Go on the Bloomberg. I feel like his key message is this whole idea of kind of what they talked about at the top, this whole idea that he sees a setup for a recession unfolding specifically, and talked about, Americans stung with traumatic levels of inflation, Katie. And so recession maybe because the Fed's going to need to raise interest rates further. We heard that from Jay Powell this morning.
He did say that the Fed is in uncharted territory, but also didn't seem too impressed with how the Fed has been communicating. He said that their messaging thus far has been counterproductive. And on the debt ceiling, I know we've been following that. He called it a non-event until it is an event.
Ain't that the truth? We're going to talk about that a little bit later on. It's a story that's in Bloomberg Business Week, the upcoming new issue, so we'll get to that in just a moment. In the meantime, let's get a check on that market trade, some big moves when it comes to the Treasury trade and certainly the equities. Here is Charlie Pellet.
Hi, thank you very much indeed. 11 minutes to go before the closing bell clangs on Wall Street. The Dow, the S&P, NASDAQ deeply in the red. This update brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. The ERC is not alone. It is money your small to medium-sized business may be eligible to receive for keeping employees on payroll in 2020 and 2021. Get an estimate of your company's potential refund today. Learn more at getrefunds.com. Right to the numbers, fast-moving markets. S&P down 62, a drop of 1.5%. The Dow down 565, a drop there of 1.7%. NASDAQ down 146, a drop there of 1.3%. The two-year yield, we begin there, 5.01%. Worth repeating, 5.01% on the two-year, with a 10-year 3.96%. Spot gold down $31 the ounce, down 1.7%, $18.50. West Texas Intermediate crude down 3.8%, $77.43 a barrel. Billionaire Ken Griffin said the setup for a recession is unfolding, with the Fed needing to raise rates further after Americans were stung with traumatic levels of inflation. And in a conversation broadcast live right here on Bloomberg, Griffin also talked about the work ahead for the Federal Reserve.
Everyone has these very high expectations that the Fed can just work magic on inflation, and they don't have it that easy. And that's why I really believe that the consistency of messaging is so important, because part of how the Fed gets the job done is the perception of the American public that they can get the job done.
Citadel's Ken Griffin interviewed live on Bloomberg Radio. Again, recapping equities selling off close to session lows, with the S&P down 62, down 1.5%, 2-year 5.01%, the 10-year 3.96%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just about 8 minutes left in today's trading session. Charlie, of course, breaking down the trade. Let's get to it. Let's get to our drive to the close guest, Katie.
All right, we're going to be speaking with Sue Crotty. She is Senior Vice President and Chief Investment Officer over at Siegel Marco Advisors. She joins us on Zoom from New York City. And Sue, we were just listening to Ken Griffin, but if we rewind back to 10 a.m., we heard from Jerome Powell himself, the Fed chair, and it seemed like he really shocked markets here by sticking to the script. He did seem to open the door to maybe a 50 basis point hike at the next meeting. But other than that, I mean, it was higher for longer, the same kind of messaging that we've been hearing from him. What was your takeaway?
Well, exactly that, higher for longer. But I'm always amazed that people have not believed him when he's been saying this pretty clearly throughout. The problem is not solved. We still have inflation. We saw the pattern of it coming down, through the end of the year, which was good news, but it wasn't down to the levels that, you could say that the market was going to be able to pause or that he was going to be able to go the other way, which was sort of why it was amazing that the whole, year end and into January phenomenon did occur.
So
a lot of hope.
A lot of hope. Well, fair enough. Do you feel like the markets are now priced in terms of fixed income, treasury trade, and equity trade, priced for what Jay Powell reminded everybody again that he's going to do, Sue?
Yeah, we're getting there. We were saying here at Siegel Marco through the end of last year, this is a very data-dependent market. And, as it zoomed through the fourth quarter and up through January, having EFI up, 27% was clearly, things, or the S&P up, equally, almost equally. It got far away from itself. It was the world trying to look ahead and not really listening to what the reality of the data is. These things take time. This is not a quick reversal. It never has been in the history of the markets. And it won't be this time either. I think a lot of it is there's a lot of people out here investing in the markets that have never seen this sort of thing. So they just hoped we'd go back to the, to the
Well,
Fed
has anybody
push,
really
because
seen
that's
this
what they
sort
were
of
used
thing,
to.
Sue, to be fair, in that we're coming off a pandemic. We had tons of stimulus coming at us globally. Have we...
True. Yeah, no, we haven't seen a pandemic before. We haven't seen that sort of consumer demand that was the first thrust of this whole inflation era. Absolutely. But we've seen inflation before, and we've known what tools are there, and we've known how long it takes for those numbers to come through into, the data. And no one seems to be, looking at history very well these days. And there's a lot of people that just keep, look, we want it too. But we've always been in the camp here that raising rates is a really good thing. We were, when we started to raise rate before the pandemic, it reversed it all. We were cheering. You can't live in a world of zero rates. ZIRP is not a world where you don't create a lot of excesses and a lot of issues that are going to come to the front at some point. So in our books, this is good news. Having a real return on your fixed income portfolio provides a lot of protection for people. It provides savers and retirees with money that they just couldn't get for over a decade through the 80s as we wore off first the GFC and then the pandemic.
And Sue, we don't have a ton of time here, but when you say fixed income, fixed income actually has income nowadays. What specifically are you talking about? Are you talking about treasuries, or are you looking at corporate credit as well?
And just got about 40 seconds.
Both. Yeah, both for sure. We think you should be high quality because we are late in the cycle in terms of, the credit. We funded a lot of companies, through the last decade plus that probably couldn't have gotten it in another environment. So you do have to be careful. We do believe in active management as a result of that because, it is going to be a little trickier in corporate credit.
All right. Wish we had more time. Come back soon. Sue Crotty, she's Senior VP and Chief Investment Officer at Siegel Marco Advisors, joining us via Zoom from New York City. Katie, we've got stocks just off their lows of the session, but down more than 1.5% on the S&P, NASDAQ down about 1.25%. But, most notable is what we're seeing on the Treasury side of things. Just pulling it up on my Bloomberg, that 2-year easily still above that 5% mark.
A lot of superlatives on a day like today.
All right, folks, we're going to head over to our TV colleagues. Beyond the Bell starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
Right now, we are about 2 minutes away from the end of the trading day. Romaine Bostic, Scarlett Fu, we're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Carol Massar and Katie Greifeld. Welcome to our audiences across all of our platforms, Bloomberg Television, Radio, and Originals, as well as for those folks on YouTube. We're down about 1% across the board here, Carol, in U.S. equity markets. The shorter end of the yield curve higher, the longer end, believe it or not, slightly lower.
Yeah, it's interesting. We were just talking with Sue Crotty over at Siegel Marco Advisors, and she says we're getting there in terms of the markets catching up with what the Fed is truly going to do, and she's talking about valuations. But she also reminded us, right, Katie, ZERP. This low rate, no rate environment that we've been in is not a world that you can live in. And she thinks some of the market moves, finally, you can actually see some real rates of return, and that's a good thing.
Absolutely. The income is back in fixed income, especially on a day like today. I'm still thinking about the 2-year Treasury yield above 5% for the first time since 2007. I mean, this is a day of superlatives.
I'm also looking at trading volume that has picked up quite a bit from the 10-day average, up 21% from the 10-day average, in contrast to yesterday when everyone was just sitting there waiting for Powell to speak.
Yeah, absolutely. And we get another day of testimony out of him tomorrow here. Of course, the prepared remarks, probably not going to be much different than what we heard today. The Q&A, of course, the very different complexion in the House of Representatives
could
certainly be a little bit different. They've got some character.
Entertaining.
Have you seen the new makeup of the House of Representatives? Anyway, enough politics here on the day. I think Ken Griffin gave us enough of that here. We go back to the markets here. And I think the idea that, guys, we really haven't gone anywhere. I mean, we're basically flat on the year. I think still technically in the green on a year-to-date basis here. So for all of the agita here, this is still a market that remains range-bound. A decidedly down day today, a significant down day today, with the Dow Jones Industrial Average going to finish lower by almost 600 points, or roughly about 1.8%. The S&P is lower by more than 60 points, or about 1.5%. The NASDAQ Composite lower by 144 points and change, basically about 1.25%. And the Russell 2000, Carol Massar, is going to finish the day lower by about 1.1%.
Romaine, you talk about being range bound. So I'm looking at the Russell for the year up about 6.7%. You've got the S&P up just shy of 4% for the year. The NASDAQ 100 still with a gain of about 11%. So a little perspective here.
And just taking a look at the industry breakdown here for the S&P 500 today. 24 industry groups, everything is in the red. In fact, the worst performers are the financials. Romaine, we talked earlier about KeyCorp and how it gave a lower forecast for net interest income as interest rates rise and they have to pay out more to depositors. That is feeling its way through that sector. Even the best performing sectors, some of the more defensive ones like food and staples and telecoms, they're still down about 0.4%.
All right, Scarlett, so that's a look at the major industry groups in the S&P 500. Let's get to some individual gains. outperforms. In terms of standouts, there were a few outperformances, and that was among...
Wow. Well, you got to start from the bottom here. Weight Watchers, WW up 79% on the day.
Aren't you, like, blown away by that?
I know.
It's a $6,
So now
almost
they're a
$7
telehealth
stock.
company? What's going on?
Well, what's interesting, I've actually had dinner and talked with the new CEO, or relatively new CEO of the company. She's got a digital social background, very interesting. And it does look like they are thinking about the digital platform kind of being all in when it comes to health and wellness, maybe more medically oriented. They did do an acquisition. They just bought a digital health platform, clinical weight management. They also did report EPS above estimates and sales in line. So soaring up 79%. Just quickly, airlines, a standout in today's session. We talked about multiple carriers being upgraded, including United Airlines upgraded to outperform, some other ones as well. UAL alone up about 3%, but UAL, Delta, American, they were all top in the S&P 500. Also watching JetBlue and Spirit, of course, a challenge from the U.S. Justice Department. You mentioned, Romaine, that JetBlue says we're still going to go ahead, but it does, while those guys are busy and distracted, what it means maybe positively for some of the other players. AMD just quickly up 1.2%. Top in the S&P and NASDAQ 100. AMD among the 13 stocks that Morgan Stanley came out recommending for the trough into the next bull market. There's a lot more there, but just interesting, again, this name continuing to see some momentum to the upside. Kate.
Carol, you stole a little bit of my thunder, but that's all right. Let's start with JetBlue. Of course, we all know the story. You had the U.S. move to block its $3.8 billion acquisition of Spirit Airlines. So that was a two-parter and involved filing that antitrust lawsuit and also withholding certifications for the carriers to combine their operations. We did hear from the CEO a little bit earlier. He said that he's still confident that they'll win this and that the integration plans will continue, but you can see the shares down by about 3%. Moving on, Rivian, this is an interesting one. So they announced today that they're going to raise $1.3 billion through the sale of green convertible bonds due in 2029. Stockholders aren't too psyched about that. That does have the potential to dilute the value of the outstanding shares. You can see the shares down almost 15%, 14.6%. Bloomberg Intelligence did note that this sale does help to shore up liquidity into 2024. And I wanted to end on Thor. It's an RV maker. They produce those gorgeous Airstreams. You see them on the highway. They reported weaker than expected results. They give a pretty grim outlook. You have demand for RVs slowing, and you can see the shares ended about 3.8% lower.
All right, we go from the stock market over to what we saw in treasuries today. Sovereign yields on the shorter end of the curve are higher. Probably the big news of the day is a two-year yield now above 5% here, 5.019 to be precise here on the day here. A 5-year also elevated on the day. But that 10-year yield, while it is slightly elevated, it did trade above 4% on the day. It's back down below that at 39696. And this is the point that Jason Katz, I think, was making over at UBS Private Wealth. The idea that when you look out at the longer end of the curve, your 20-year yield, 30-year yields, and start to see those yields a little bit more subdued and actually coming down, I think it gives you a sense here that investors' attention is shifting to maybe a little bit more longer duration and maybe a little bit more of a positive outlook once we get through this bumpy road here. And I guess the bumpy road is going to be, well, data dependent.
Bumpy road. Thank you for that. Yeah, data dependent. And that's what I was going to say. I know. Thank you for the gift. I was thinking about Friday, jobs report. Could that change the tone again in the financial markets? Then you've got next week the CPI print. So a couple of key data points before that next Fed meeting, before we get that dot plot. I know what Jay Powell laid out there, but he said they are watching. That will impact what they come out to say.
What's the threshold, though? I mean, 200, 200. I mean, in terms on payrolls, we got 200,000 is basically the analysts, the economist estimates here. I mean, that would be a big downshift from where we were, I guess, the previous.
It would be a big downshift, but the
that's
trend,
healthy, right? I mean, 200 grand. I mean, we would have taken that any day of the week.
The thing is, you have to keep in mind that for the last 10 months, we've had economists come in below estimates when they were trying to forecast out what kind of job growth we would get. So they have missed estimates for 10 straight months. That's the longest streak in decades. And they've fallen short by an average 100,000 payrolls per month.
You don't want 517,000, that's for sure, right?
No. Why not? I mean, I'm not trying to be facetious here.
No, I want people working. I think that gives the Fed some room,
okay, but
to
this
raise
is what
rates.
came up at the hearing today, and I'm sure it's going to come up tomorrow, the idea that there is this disconnect now between how the Fed fights inflation and maybe tries to do it in a way that isn't about putting us all out of work. Is there an economic formula for that? I mean, I don't know.
Well, how else to bring down inflation then?
Yeah. Didn't he talk about that he thought that maybe to some extent there'll be some pain, but maybe he seems to think that it doesn't have to all come undone?
Yeah, no one believes him. Earnings crossing the wire, CrowdStrike, shares higher here in after-hours trading. The 4Q numbers coming in, looks like a beat, 47 cents on adjusted EPS. The street on average is looking for 43 cents. Revenue also coming in higher at around 637 million. And here's your guidance going forward. Full year adjusted EPS for the fiscal year, $2.21 to $2.39. That would be above street estimates, and full year revenue at $2.96 to $3 billion. The high end of that estimate is above the average.
And it's all about the guidance. That's been the story of this earnings season. You can see that boost in CrowdStrike shares up about 9% after hours. Needed boost for this stock. If you look over the past year, it's down to the tune of 25%. So clearly traders like what they see there.
You know, I don't want to steer attention away from earnings too much, but in looking at the eco calendar and looking ahead to jobs, I noticed that consumer credit did come out today. And Romaine, you and I were talking about this, how consumer spending is still very strong, helped, of course, by the tight labor market. Actually, consumer credit increased in January by less than forecast.
Well, I'm glad you brought that up. I forgot about it. I mean, it came in basically at around 15 billion, I think 14.8, and the street was looking for something like 25. But keep in mind, that's well below where we were over the last year. I mean, keep in mind, we were tracking on a monthly basis at around 30 to 40 billion, and we had that big downshift in December down to like 11, and now you're downshifting again in January. So I don't know if that's a good sign or a bad sign. I mean, it shows that people are taking out less credit or utilizing less credit, but that also means, of course, they're spending less in theory.
Right, exactly. But does that help then bring down some of the inflation, right, and the demand that's been out there for various things?
Yeah, we don't know what's driving it.
I don't mean to stir the pot here, but I got to go back to that 500,000.
Yes, you do.
Because I know that this is sort of common economic theory. We only got 30 seconds to sort of break this down and solve this problem. But I am curious as to why there is not a way for them to find a mechanism that preserves the stability of the job market while at the same time bringing down price levels.
Maybe it's not on the Fed to do that. We had Diane Swunk talk to us yesterday of KPMG saying that if employers and employees can find the trust with each other to negotiate pay increases that reflect the higher cost of living, but that don't put a dent in companies and what they're capable of handing out to employees and also allow them to continue operating, maybe that's a way to get inflation under control.
So in other words,
that requires a lot of trust.
Keep them on the payroll, maybe take back their wage increases, or don't give them any more wage increases?
I don't know. It'll require compromise on both ends.
Yes, that will.
Yeah, that'll go over really well, right?
There you go. So then you have the Fed raising rates.
Carol,
no, it's tricky.
I see why you're not on the Fed.
There's a lot of reasons why. All right, guys, that's a wrap. That'll do it for our cross-platform.
Katie?
Hey, I'm just enjoying the atmosphere, honestly.
All right, guys, that'll do it for our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals, Beyond the Bell, we call it. We'll see you again, same time, same place, tomorrow. Oil, with a possible recession looming and as wages haven't kept pace with inflation and more. So let's get some thoughts on financial wellness. With us is Sarah Levy. She's Chief Executive Officer of the Independent Digital Investment Advisor. We're talking about Betterment. Sarah, by the way, spent over 20 years at Viacom, was COO there. She is joining us via Zoom in New York City. Hey, Sarah, great to have you here with Katie and myself. What's the question, first of all, that you get most asked about in this investment environment? To say it's unusual is probably an understatement.
That is an understatement. Thank you so much to both of you for having me. I think probably right now the most common question is a pretty basic one, which is, what should I do with my money in these volatile times? And I think that's a question being asked by investors at all stages of their investment journey.
And so all stages of their investment journey, obviously, if you think over the past 2 years, the retail investor was a type of investor that we got very well acquainted with. Obviously, the market environment in 2022 was much different from 2021, 2020. What is the state of the retail investor now? What are you seeing at Betterment?
So our philosophy in general has been sort of tried and true in terms of starting with a long-term plan, sticking to your plan, being diversified, and not getting distracted by the markets. what is interesting to see right now is that, there are other platforms and investment solutions that don't necessarily preach that sort of consistency. And so, as you point out, in 2021, there was a lot of excitement sort of chasing the latest trend. We at Betterment never really believed in that. And so I think by and large, we attracted a consumer who agreed with that philosophy, which was, don't get distracted and don't make changes when the market moves, because this is really about a long-term play and it's about long-term savings. So if you take that as context, what we're seeing now is that we're seeing a lot more money being put into savings because it's a high yield environment and there is a lot of great rate available while people are sort of waiting out, the Fed and waiting to see kind of what the markets are going to do.
Great. That's what I wanted to ask you. Your platform, avails you a lot of information. And I was curious, what were some of the dominant broader investment trends right now? So people in cash, shorter investment trends, basically maybe a big sign of risk off at this point and just kind of waiting it out?
Yes, I would say for sure risk off. Savings is absolutely a place people are putting their money. But retirement investing, I would say, is remaining stable. So people putting money into IRAs, people putting money into their 401ks, those remain really good, sort of long-term, thinking about compounding interest and thinking about kind of tax-advantaged investing, I would say is much more resilient than taxable accounts right now.
Sarah, are they reducing the amount of money that they're putting in their 401k or retirement accounts as a result, as we talk about this kind of more cautious stance?
We're not seeing that. We're seeing a very, very consistent habits in retirement accounts. And what we're seeing is really a shift that money we maybe saw last year going into investing, those same dollar values are going into savings this year.
And when you say going into savings, could you break down a little bit more of what that means? Because a conversation I have all the time is that cash earns something right now. If you're talking about treasury bills, if you're talking about money market accounts, the yields there are higher than they have been in a long time. I mean, just specify what you mean by savings.
That's right. Yes. So I think on our platform, what we offer is a high yield cash account. So that's where we're really seeing the activity. We're currently offering a 4% APY, and that's really top of market. One of the things you see is that, the bigger banks have lower rates and that they're benefiting from this cash environment. But we see the opportunity to really pass that along to our consumers. And so it's been a really great way particularly for our tenured customer base, but also for new customers to kind of enter for the first time and say, I'm going to put my cash here, I'm going to get some yield. And there hasn't really been a tremendous amount of incremental yield to be gained through duration. So the idea of sort of locking up your money isn't really necessary right now in this climate because short-term rates are so high. So that's what we're seeing.
Sarah, one thing I wanted to ask you, AI. You guys, generally speaking, platforms like Betterment or robo-advisors, no stranger to investment algorithms. The focus now on ChatGPT and generative AI, what are the conversations that you guys are having around that? And whether some of the folks on your platform are like, hey, what are you doing? What does this mean for us?
So it's interesting because I would say we are an automated platform. I think to say that AI is powering our investing would be disingenuous. So we really have, real professionals behind the scenes. Those human beings, so not the technology, are actually putting together the portfolios for us. What the technology is doing is rebalancing portfolios according to the rules set by the humans. So I think in that sense, things like ChatGPT are not impacting our portfolio construction. I think where we're seeing the potential of ChatGPT, again, sort of very early days, is thinking about messaging and marketing and taking the temperature of things going on in the industry, where you can work with your creative teams to really kind of meet the moment.
So less so for necessarily screening for holdings, more like you say, it sounds like more language-based applications is what you're looking for.
So far, that's where we are. We don't yet see the application necessarily. I think humans still have a real role to play in investment selection, and it's pretty complicated. So we're not there yet. I would say
the humans around the world. Thank you, Sarah. We do want to ask you, Goldman Sachs with Goldman tomorrow. You guys are hosting a panel and an event, International Women's Day, financial empowerment on the agenda. Tell us a little bit about it and what your focus is.
Yes. So I'm really excited to be joined by Patty Raphael, who is a longtime Goldman Sachs wealth executive. She's had a tremendous career. And so the two of us, what we're hoping to do is really share tips on investing, on careers, maybe on life. And she's a fun and fabulous woman. So hopefully there'll be a little personality and people will come away with some practical and easy to implement tips on sort of how to do the best with your money.
Are we getting more empowered? Can I just ask you? I feel like we've been talking about financial empowerment for an awfully long time, probably easily a decade or two. Are we getting more financially empowered in your view?
Well, I don't know that this is really just about women, to be honest with you.
I agree.
I think women sort of carry the stress sometimes more. And so what we can do is we can demystify some of that by really breaking it down, by offering ways that technology can make things kind of simple and set it and forget it. I think what I'd like to do is really show people that it's not that scary. I think the word investing can be scarier than the word saving. And really, they're just two sides of the same coin, right? It's about starting early. So are we more empowered? I mean, I like to think so. I like to think about these, senior women who have had great careers and think that sets an example for what the future can hold for the next generation.
I really like that point that savings sounds safer than investing. But I mean, we don't have much time left. But I'm also curious, in 30, 40 seconds, what does financial empowerment look like? That's a word we toss around all the time. But what does being empowered financially actually mean?
I think being empowered financially starts with a plan, right? And there's a rule of thumb you can follow, or you can personalize, and that's, your choice in terms of how deep you want to go. I think being financially empowered is understanding what's available to you. The government offers a tremendous amount of tax advantages. You want to take advantage of that, right? Whether that's a 401k or an IRA or all the other, various accounts for educational savings. I think being empowered means compound interest, means taking advantage. Time is money. Start now, no matter how small. And then I think lastly, I would say, make it simple and stress-free, and that's where technology can help.
All right. Got to leave it on that note. Good luck with your event tomorrow. Sarah Levy, she's Chief Executive Officer at Betterment, joining us via Zoom from New York City. Carol Massar, Katie Greifeld, we are Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg. Down day for the Dow, the S&P, and NASDAQ. A 1.5% drop today for the S&P 500 index. Now at 39.86. It tumbled 62 points today, closing very close to session lows. The Dow down today by 575 points, down 1.7%. The NASDAQ Composite Index down 145, a drop there of 1.3%. The 10-year yield 3.96% with a 2-year at 5.00%. Wall Street got a big reality check today as Jay Powell's hawkish rhetoric prompted a shift higher in Fed rate wagers, reviving recession fears and crushing the riskier corners of the market. You heard his testimony live right here on Bloomberg Radio. Spot gold down $32 the ounce to $18.14, drop there of 1.7%. Big drop for West Texas Intermediate crude, tumbling 3.8%, $77.40 for a barrel of WTI. CrowdStrike forecast revenue for the first quarter, and that guidance beat the average analyst estimate after ours CrowdStrike shares surging now by just about 7.5%. So again, recapping, the 10-year 3.96%, the 2-year 5.00%, S&P down 62, drop there of 1.5%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. You're listening and watching Bloomberg Business Week. Carol Master along with Katie Greifeld. Well, the EV world definitely on a mission. That is to track down and lock up access to the world's lithium stockpiles. Institutional shareholders have been doing it, Katie. Tesla, too. So, too, now is General Motors. So, we got a perfect voice to get to on this.
I'm so excited to talk
We
to
want to
him.
know why he's been laughing. We've been watching him off air. We want to know what's going on behind the scenes.
Ed Ludlow, he is the co-host of Bloomberg Technology. He joins us now. He's in San Francisco. I can tell because there's a big red bridge behind him. Ed, how are you doing?
I'm doing great. Full disclosure to our global audience. Chelsea have just scored a second against Borussia Dortmund, and I'm absolutely overjoyed as a suffering Chelsea fan this evening. Let's get back to the story we want to discuss. I apologize.
Hence the photos. There's a bunch of pictures we wanted to share with everybody, but we kind of reined it in a little bit. All right, so let's talk about lithium. What's going on?
The really interesting analysis by our equities team. This is an equities story, it's a commodities story, and it's a company's story. But Escher Day and co point out that you look at some of the asset managers that have been piling into lithium stocks, lithium miners, many of them are the same names that have bought into Tesla, right? And in fact, if you look at some of the action, names like 1832 Asset or Manulife Financial as examples, in some cases, these are companies that are buying into lithium stocks but trimming exposure to Tesla. The point is there is this real consideration from investors out there that if you want to get in on the EV transition, it's not just the pure play names or the legacy automakers you want to be investing in. You actually want to go to their supply chain, and lithium is a key battleground. Although, as Elon Musk told us last week, not just about mining, also about refining.
That's really interesting. And I mean, hearing you talk about it, the fact that, in also buying stakes in, lithium miners, they're also trimming their holdings in Tesla. Is that almost like it's too hard to pick a winner in the EV fight? Let's pick what these EV makers all need, and it's lithium.
That's a difficult question for me to ask because I'm not an investor. But what I would say is this, is there are different ways of doing it. So if you look at General Motors, for example, they have actually gone on to invest in some of the miners themselves. What Elon Musk was saying last week is that there isn't a problem around access to lithium from a mining standpoint. There's no sort of monopoly on lithium deposits around the world. It's there. The problem that they have is that you have to turn lithium concentrate into battery-grade lithium chemical. The refining process is where Tesla has chosen to invest. Other automakers, Stellantis included, General Motors, we've reported is trying to get a stake in Vale right now as an example. They're looking to the mining because they want to control that supply chain component at root source. Investors are trying to hedging in between, right, and taking stakes in both, as well as the autos names themselves.
The thing is, though, Ed, getting hold of or investing in the miners, it's not a guarantee, right? There's risks to that investment strategy as well.
Well, I think, one of the things that we've reported, for example, my colleagues and I, is that Tesla was considering buying Sigma, a Canadian mining firm, but that was based on them securing the ability to mine in Brazil at a later date. That carries risk. Now, Tesla never commented on that story, and what I was told by one source is that was one of many options that Tesla was looking at. That's a risk in and of itself. Right now, though, what Tesla is struggling with is battery cell supply, and that's why you put the emphasis on mining, turning the lithium deposit into the actual chemicals that go into a lithium-ion battery cell. And it relates to other batteries as well as nickel. The reason this is fun, and I can see Katie's eyebrows just perking up at the word fun, is because lithium is one of the best performing commodities of the last 2 years, so we get to track it from that side as well.
Fun, yeah, that's one way of describing it.
I mean, I love, like, over the past 2 years, we've all just gotten into little market niches that we had no idea.
Right.
That would I ever think about lithium? Like, I don't know. But now I do.
Not, but now we all do, right?
You do now.
Here we are.
One thing we do think a lot about?
Tell me.
Tech job cuts.
Yeah.
Sorry, I couldn't think of any other easy segue there.
It was a segue, though. Ed, tell us about Meta. I'm looking at your bio.
Yeah.
I see an exclusive here. Meta said to cut thousands more jobs as soon as this week.
Yeah, look, and I start by saying it's never pleasant discussing people losing their job or layoffs, right? And what Sarah Fryer, Kurt Wagner, and I reported last night is these are fresh layoffs, potentially in the thousands, on top of the 11,000 that Meta did at the end of last year, and on top of the sort of flattening of middle management that Meta has done so far this year. What we heard from sources is that VPs, directors are compiling lists. Those lists total in the thousands, and that layoffs would come in the next week. And why it's interesting, why the next week and so pressing, we're told by one source that Mark Zuckerberg is about to go on parental leave. He's expecting his third child. So the managers that are administering these layoffs want to get it done before the imminent birth of his third child, before he goes out on parental leave.
What are they trying to accomplish? I know it's, an effort by Meta. They've been trying to flatten that org structure. But what do they think that, actually cutting jobs in the thousands is going to accomplish?
A big part of this story is bloat, right, from the pandemic era. So for our global audience, if you imagine all of the mega cap tech companies, everyone from Apple, Amazon, Alphabet, the parent of Google, and Meta, they all hired like crazy, actually apart from Apple during the pandemic period. The difference is that Meta wasn't able to grow its top line in the same way its mega cap peers were. In other words, they hired all these people, but weren't realizing additional units of revenue per new employee they hired. If you tabulated that, they'd be right at the bottom. And so they're having to undo this bloat. That's why there was a big emphasis on middle managers. At the same time, I reported last week, guys, I don't know if you saw, but a real reason they've cut prices on the hardware side of their business, no one's buying it. There's a slowdown in that new nascent area for Meta, and a slowdown in their core advertising sales as well. And they're just trying to get more efficient. This is the year of efficiency.
All right, so the year of efficiency, and we're only at early March here. And as you said, and rightfully so, Ed, it's not easy when you're talking about job cuts at a company, another round. Is this it, or who knows?
I think what's so interesting is that you have to weed through the data. If Mike McKee were here, he would say, look at technology jobs. Those are layoffs announced. They're not yet layoffs enacted. So we always track this Challenger, Christmas, and Gray data, right? But those are just announcements that are tracked. There are 155 million jobs in this country. A very small proportion of them are in technology. And if you look at the jobless claims data at the state or national level and the jobs data on a monthly basis, there is evidence that people are finding new jobs quite quickly. And indeed, anecdotally, on the Bloomberg Technology Show, we hear that. There are VCs that are just kind of licking their lips because there are talents on the market who have had years at really big tech companies that would not otherwise be available. So what you see is VCs writing checks to their portfolio companies and saying, actually, this is a really good time to hire. You're going to get people that you would not otherwise be able to get in any different market environment.
A lot to think about, of course, as we await Friday's payrolls print. Some food for thought there. Ed, while we still have you, should we talk about Elon Musk? Do you want to do that?
Oh, please. Yes, It's been a busy day.
We heard from him today.
Wait, there's news on Elon?
Yeah, he was speaking at a Morgan Stanley conference in San Fran. I don't want to talk about Tesla, though. What did he have to say about Twitter? What did we learn there?
So this was with Morgan Stanley's global technology investment banking head, Michael Grimes, on stage very quickly. Twitter will be cash flow even, break even by the second quarter. There's a shot at cash flow positivity in the second quarter. And what Elon Musk said is that as a result of all the cuts that he's made to staff and real estate, Twitter's in a position where it's EBITDA profitable on an EBITDA basis. But as he put it, there's a really big emphasis on the debt, which is $1.5 billion annually to service. So it's not out of the woods yet, but the situation's looking better according to Elon Musk.
There you go.
Still amazing, right? We all talk about it. We all use it, certainly in the media world.
And even
yet,
still,
it doesn't make a ton of money.
It doesn't make a ton of money, and I'm always itching to check what the shares are doing, and then I can't.
I know. I do that all the time,
Yeah.
right? It's like the default. I'm like, oh, no. Go back to your game. See, are you checking
He's
your
already
game again?
checking
Oh, my
it.
God, he's already checking his game.
All right.
Caught, Ed Ludlow.
Get
Caught
outta
him.
here.
We're tracking you. All right, Ed Ludlow, of course. He is Bloomberg Technology co-host Ed Ludlow from our Bloomberg 960 studio in San Francisco. Catch him on Bloomberg Technology Daily on Bloomberg Television.
We
What?
can look at Tesla shares. They're
Yeah.
down right now, 3%. I don't know. Tesla's all over the place.
It's on a tear, though, this year, right?
Yeah,
I mean, it's up
yeah.
more than 50%, but mind you, I mean, still way off. But yeah. Oh, Elon. There's always something every day. All right, folks, let's get a check on world and national news. Off to Denise Pellegrini. She's in our 1130 newsroom. Hi, Denise.
Hey there, Carolyn. We've got something new about China travel because watch for more tourists from China. Again, the U.S. set to lift the COVID test mandate on travelers from the country, according to the Washington Post. We're also keeping an eye on Florida, where Governor Ron DeSantis says he will sign a bill allowing Floridians to carry firearms without a license.
I'm going to sign what they do. So if they do a permitless bill and that gets to my desk, I'm not going to veto that.
And DeSantis also promising this will be Florida's most productive legislative session ever. Former President Trump may already be thinking about running mates in his next White House race. Bloomberg's Nathan Hager reports.
According to Axios, the former president is strongly thinking about naming a woman to run alongside him, and someone like Carrie Lake could be his model candidate. The former TV anchor lost her race for Arizona governor in November, but she has been a vocal supporter of Trump's false claims of a stolen 2020 election. Other names the former president said to be considering are Nikki Haley, who's also running for president, as well as Arkansas governor and former White House spokeswoman Sarah Huckabee Sanders, and South Dakota governor Kristi Noem. In Washington, I'm Nathan Hager, Bloomberg Radio.
Thank you, Nathan. 2 kidnapped Americans are said to be back on U.S. soil. 2 others, though, confirmed dead in Mexico. And White House Press Secretary Karine Jean-Pierre says, travel to Mexico at your own peril.
When it comes to the travel advisory for this particular area in Mexico, that remains at level 4. Do not travel due to crime and kidnapping. We've been very clear about that. The State Department, again, has put that out. We urge Americans to read these alerts before traveling.
Meantime, a local official in Mexico says the Americans were not the intended target of this kidnapping. And he calls it all a misunderstanding, though. As I mentioned, 2 people have been killed. Global news 24 hours a day. I'm Denise Pellegrini, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
4:40 on Wall Street. We check markets all day long here at Bloomberg. I'm Charlie Pellet. The Dow, the S&P, NASDAQ all finished the day deeply in the red. But first, a headline from the Bloomberg Professional Service. Goldman Sachs is adding a July Fed hike to its forecast, also raising its peak call. S&P down 62 points today, a down drop there of 1.5%. The Dow was down 575, down 1.7%. NASDAQ down 145, a decline there of 1.3%. Wall Street got a reality check as Jay Powell's hawkish rhetoric prompted a shift higher in Fed rate wagers, reviving recession fears and crushing the riskier corners of the market. The two-year yield 5.00%, with the 10-year yielding 3.96%. Spot gold down 1.8%, 18.13 the ounce. Crude down 4.1%, 77.15 a barrel. Stocks finished very close to session lows today. Again, the S&P down 62, down 1.5%. We had the Dow Jones Industrial Average down 575, down 1.7%. NASDAQ down 1.2%. Well, as for the overall mood of the market and the inflation outlook, Sue Crotty is Chief Investment Officer at Siegel Macro Advisors, and she was our guest right here on Bloomberg Business Week.
But we've seen inflation before, and we've known what tools are there, and we've known how long it takes for those numbers to come through into, the data. And no one seems to be, looking at history very well these days.
Goldman Sachs CEO David Sullivan says there is a meaningfully higher chance of a soft landing for the economy now than there was 6 months ago, echoing the sentiments of his peers that the U.S. could avoid a serious downturn. His comments came at the RBC Capital Markets Global Financial Institutions Conference yesterday. J.P. Morgan Chase CEO Jamie Dimon, in a Bloomberg radio interview, offered projections for the U.S. economy similar to Sullivan's, saying a deep recession might be escaped. Today, Goldman down 3.1%, J.P. Morgan Chase down 2.9%. Recapping the two-year, 5.00%, 10-year, 3.96%, S&P down 1.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie Pellet there with the Bloomberg Business News Flash. Well, Katie, another day, another drop of headlines from China overnight, including a Chinese warning that soaring U.S.-China tensions risk blowing past any guardrails in the relationship, showing that divisions between the world's biggest economies are becoming more entrenched. That story on the Bloomberg. With a roundup, though, of what investors need to keep on their radar. Lucky for us, and back with us is Bloomberg Economics Chief Economist Tom Orlik. He joins us via Zoom from Washington, D.C. It does feel like we're getting lots of stuff out of China right now. This warning, is it just kind of tit for tat back and forth, or just a reminder that these relationships, the one between the U.S. and China, Tom, is just getting worse and worse?
So I think what's striking about this, Carol, is that China has come out and said it. Of course, it's no surprise to anyone, certainly no surprise to Bloomberg radio listeners, that US-China relations are pretty rocky. There are trade tariffs. There is deep disagreement over Taiwan. There's deep disagreement over the future of technology. There's deep concern about what's going on in Xinjiang. So rocky relations between China and the US are not a surprise. But previously, China's leaders, at least in public, have kind of tiptoed around this. They haven't explicitly called them out. They've talked about certain large countries instead of naming the United States. But this time round, we've got China's new foreign minister, Qin Gang, coming out and just saying it. And that's what's new here.
So, like you said, this is a big escalation in terms of the messaging, in terms of the language that we're getting from China. What does this actually mean for the U.S.-China relationship, though? Does this translate into, I don't know, any sort of action, any sort of punitive measures on the part of the U.S.? I mean, where do you see this going?
So I think perhaps, Katie, what we're seeing is some signaling from China's new team. Don't forget that at this National People's Congress, Xi Jinping is getting his supporters, his guys into the top government jobs. Qin Gang, the person who's put a name on it, who's called out the tensions in US-China relations, he's just started as foreign minister. So perhaps the significance here is that this is a signal of a new kind of directness, a new sort of robustness on the part of Beijing. It's Beijing saying, you know what, if the US Congress, if the US White House is going to spend a lot of time on public podiums calling out stresses in the US-China relationship, we're not going to dance around it either, and we're going to start sharing how the world looks from our perspective.
So, you know, do you think, what's the end game? Can we fast forward 5 or 10 years, Tom? Like, do we know what it means? I just think about beginning of my career, like business journalism. It's like all of the big multinationals everywhere just wanted to be in China. They were setting up shops, they were doing partnerships to get factories going and so on and so forth. That's what it was all about because they thought they would get a piece of the Chinese domestic consumer. Now China obviously looking to kind of do it all on their own. So is there, how do you think about it? You understand this market. 5, 10 years from now, is there this severe separation and then we don't see multinationals, global multinationals selling in China? Like, I don't know. Do we know how this plays out?
I mean, it's a huge question, Carol. And if I had a crystal ball which could help me see 5 or 10 years into the future, I'd, well, I guess it would be pretty valuable. I think one thing which is striking, though, is that on the United States side, at least from the administration, you hear them attempting to kind of thread this needle where they say, yes, we're going to compete fiercely with China. We're going to block their access to crucial technologies. We're going to condemn what we see as human rights violations. But we also want stable trade relationships. We want our multinationals to be able to carry on selling into China and so on. And I think what we're hearing from Beijing at this year's National People's Congress is, well, you know, perhaps that isn't going to work. Perhaps that needle is impossible to thread. If you don't want to sell us your more advanced semiconductors, if you want to block our technological development and so block our kind of economic development, that's going to be a problem. We're not going to pretend that we have normal, stable, friendly relationships with you.
And Tom, this signaling that we're getting, this escalation in signaling, what do you think the main catalyst is? I mean, I know it's a collection of things, but, you know, you mentioned chips, for example. Obviously, that's been a point of contention between the U.S. and China. We also have what's going on in Taiwan. We have the Russia-Ukraine war. What do you think really drove this very new message that we got from China?
You know, it's really striking, Katie. For all of the stresses that there are in the relationship, for all the stresses there are over everything from semiconductors to Taiwan to Xinjiang, there was a period from Xi Jinping's meeting with President Biden in Bali through to the first moment of that spy balloon saga, when it seemed like China was attempting to play nice, right? Xi, Biden meeting in Indonesia, not a lot of substance, but they smiled and shook hands. Qin Gang, who used to be the Chinese ambassador to the United States, when he first took over as foreign minister, he penned an op-ed in, I think, the Washington Post, talking about his affection for the United States. And you recall when that spy balloon was first spotted, the first reaction from the Chinese was actually to say, you know what, sorry, this was just a mistake. Now, what's happened in the time since then? Well, I think certainly the US shooting down the spy balloon didn't help, but maybe it's just gravity reasserting itself and Xi Jinping's new team saying, you know what, we know where this is headed. We know that relations between China and the United States aren't going to get any better, and we're going to stop dancing around the issue.
Just another thing for investors to kind of keep on their radar, that's for sure. Tom Orlik, thank you so much. Chief Economist at Bloomberg Economics, joining us via Zoom from Washington, D.C. Katie, you're leaving us. No, not yet.
Not yet. Come on. We have what? We have 11 more minutes together.
We do have a few more minutes. Carol Massar, Katie Greifeld, you are listening and watching Bloomberg Business Week on this Tuesday, and this is Bloomberg Radio.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Elon Musk says Twitter may break even on a cash flow basis in the second quarter and has a shot at even going positive. The company has been working on making its advertising more relevant. Musk's remarks came at a Morgan Stanley conference today in San Francisco. Starbucks interim CEO Howard Schultz has agreed to testify March 29th before a key Senate panel, heading off a planned committee vote tomorrow to compel him to answer questions on alleged labor law violations. Schultz's decision wards off a formal subpoena and follows a months-long battle with Senator Bernie Sanders, the Vermont independent who chairs the Health, Education, Labor, and Pension Committee. Apple is adding a new color to keep buyers interested in its current iPhone line until new models arrive. And with that story, here's Bloomberg's John Tucker.
Charlie, the company announced a yellow version of the iPhone 14 and 14 Plus, adding to existing midnight blue, purple, red, and starlight options. This new model, which doesn't add any additional enhancements, becomes available for pre-order March 10th. It'll go on sale in retail stores March 14th. The Color Edition gives Apple a new way to market a product that went on sale about 6 months ago, keeping it top of mind for consumers at a time when the iPhone 15 launch is still another 6 months away. Charlie?
And today we had Apple shares down by 1.5%. And those are some of the company stories that we're following for you at this hour. I'm Charlie Pellet. This is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
This is Bloomberg Business Week. Katie Greifeld along with Carol Masser. Let's now get a check on the latest world and national news with Denise Pellegrini in the Bloomberg 1130 newsroom in New York.
Thank you, Katie. We have 2 kidnapped Americans been found dead in Mexico. 2 others, though, discovered alive and back on U.S. soil. Attorney General Merrick Garland has been getting the updates.
When it comes to the travel advisory for this particular area in Mexico, that remains at level 4. Do not travel due to crime and kidnapping. We've been very clear about that. The State Department, again, has put that out. We urge Americans to read these alerts before traveling.
And White House Press Secretary Karine Jean-Pierre also saying that the travel warnings are up there and people should be careful if they are traveling to Mexico. At least 6 Palestinians have been killed in a battle with Israeli soldiers. A spokesperson for the Palestinian President Mahmoud Abbas calls it an all-out war. And Defense Secretary Lloyd Austin has made an unofficial visit to Iraq and has been meeting with Iraqi officials.
U.S. forces are ready to remain in Iraq at the invitation of the government of Iraq. Now, these forces are operating in a non-combat advise, assist, and enable role to support the Iraqi-led fight against terrorism.
And Austin in Baghdad is part of his Mideast tour. President Biden pitching a plan to extend the life of Medicare. Bloomberg's Jody Schneider tracking those developments.
It's supposed to extend Medicare solvency by 5 years from 2028 to 2053. It calls for an increase in the Medicare tax rate for those with incomes above $400,000 annually from 3.8 to 5%.
And Schneider says this plan will make the Medicare Trust Fund solvent through 2050, and it's part of the budget proposal that President Biden will unveil later this week. And a group of bipartisan senators has announced a new bill tentatively called the Restart Act. It will give the federal government additional power to review and potentially restrict communications and technology that pose a threat to national security. And this will include TikTok. We're tracking it all for you because the Biden administration says it is poised to support this bill that would help control TikTok. Global News 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Denise Pellegrini, and this is Bloomberg. Katie?
All right, Denise, thank you so much. Well, Bloomberg Business Week is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds that 70 to 80% of small businesses are good candidates for taking the employee retention credit. Don't bother trying to navigate hundreds of pages of tax code to learn if your business qualifies for ERC assistance. Let the tax professionals at Innovation Refunds do the work and help you secure the future you want for your business. Learn more at getrefunds.com.
And March is Women's History Month, and every day this month, we're celebrating significant moments in women's history. Now with your installment for this Tuesday, March 7th, here's Bloomberg's Lisa Mateo.
On this day in women's history in 2010, Kathryn Bigelow becomes the first woman to win an Academy Award for Best Director.
There's no other way to describe it. It's the moment of a lifetime.
Her war drama, The Hurt Locker, also won an Oscar for Best Picture.
How many bombs have you disarmed?